The most brilliant technical analyst in the precious metals sector recently went on record, and what he revealed should awaken every individual who believes they missed the silver opportunity. Michael Oliver, the creator of momentum structural analysis, the person who predicted the 1987 crash, the individual who has been examining commodity markets for 4 decades, just released a bombshell that Wall Street is acting like doesn't exist. On December 16th, he informed Palisades' Gold Radio that silver will reach $200 by the second quarter of 2026. That's not 10 years away. That's not 5 years. That's Q2. That's April, May, June. Then just yesterday, January 12th, he upgraded that prediction. He stated, and I quote, "My floor is $200, but I wouldn't be surprised if it approached $500. $500 per ounce. And as I'm filming this right now, silver just reached 88 days. 15. That's an all-time peak. The momentum Oliver forecasted is unfolding in real time, right before our eyes." And when the interviewer questioned him if it's too late to enter, his response was crystal clear. It's not too late. The breakout is just starting. In this emergency broadcast, I'm going to guide you through Michael Oliver's precise technical setup. I'm going to present you the momentum indicator that has never been incorrect in 40 years. I'm going to clarify why he believes multi-month corrections are finished and why pullbacks now last merely days. And I'm going to disclose the one chart pattern that demonstrates the silver market has fundamentally transformed forever. The banks want you to believe you missed it. Michael Oliver is shouting that you're early. This is the story of the technical breakout that alters everything. Michael Oliver is not a YouTuber. He's not a retail hype man. He's not selling you coins. He spent decades at E.F. Hutton's International Commodity Division in the 1970s and 80s. He trained under David Johnston, the chairman of the COMEX. He technically forecasted and profited from the 1987 crash. In 1992, Wovia Bank's trust department requested him to provide soft dollar research to Wovia. Within a year, he transitioned from brokerage to full-time technical analysis. He developed momentum structural analysis into a firm that serves institutional investors. This is a person who trades with his own capital and has been in the markets longer than most of us have been alive. When Michael Oliver speaks, the smart money pays attention. And right now, he's more bullish on silver than he has ever been in his career. Here's what he informed Palisades Gold Radio on December 16, 2025. He stated, "The conversation takes an especially bullish turn when discussing silver. I forecast an extraordinary surge in silver prices, potentially reaching $200 by the second quarter." He based this on his proprietary momentum analysis. Unlike price charts, which can be manipulated, momentum measures the underlying force of a trend. It's like measuring the engine, not the speedometer. And according to Oliver's system, silver just broke out of a multi-decade base. That breakout, he claims, is identical to what copper did in the 2000s. Copper spent 20 years trading in a range. Then it exploded. It went from low $60 to $450. A 7 times move in less than 5 years. Michael Oliver believes silver is about to do the same thing, but faster. And here's the kicker. Just yesterday, January 12th, he went back on the record, this time with the Living Your Greatness podcast, and he upgraded his target. He stated, quote, "You don't get these multi-month corrections anymore. Now they're measured in days. And frankly, we expect to see silver reach. My floor is like $200, but I wouldn't be surprised if it approached $500 to tell you the truth. $500. Let that sink in." The same individual who predicted the 87 crash is informing you that silver could 6 times from here. And he's stating it's not speculation, it's structural. The market has transformed. Let's break down the technical setup that Michael Oliver is witnessing. His system doesn't look at price alone. It examines momentum. Momentum is the rate of change. It's the force behind the move. You can manipulate price with a few large sell orders. You can't fake momentum. Momentum requires sustained buying from multiple sources over time. And right now, the momentum in silver is breaking records. Oliver utilizes something called a momentum oscillator. Think of it like a seismograph for markets. It measures tremors before the earthquake. In July 2020, silver's momentum oscillator broke a level it hadn't touched in decades. That was the signal. The price was still in the 20s, but the momentum stated, "This is the beginning of something massive." Since then, the momentum has only accelerated. Oliver claims, "We haven't witnessed a multi-month correction since the breakout began. That is unprecedented. In every previous bull market, silver would rally, then pull back for months, then rally again. It was a stair-step pattern, but this time, the pullbacks last days, not months. When silver dropped from $35 to $30 in late 2024, people panicked. Oliver stated it was noise. The momentum never broke. The price recovered in 2 weeks. When silver dipped from $65 to $62 in early 2025, same thing. The weak hand sold. The momentum stayed strong. The price bounced back in 72 hours. This tells Oliver something critical. The buyers are no longer discretionary. They're not speculators who can walk away. They're industrial users who need the metal. They're sovereign wealth funds building strategic reserves. These buyers don't care about 10% dips. They buy the dips, and that buying creates a floor that rises every month. The technical name for this is a rising support line, and Oliver claims the current support line is rock solid at $60. That means even if there's a flash crash, the price will not remain below $60 for more than a few days. The floor is concrete. Now let's discuss about the gold to silver ratio. This is the number of ounces of silver it takes to purchase 1 ounce of gold. Right now, that ratio is around 70. Historically, the average ratio is 50. In bull markets, the ratio collapses to 30 or even 20. Why? Because silver moves faster than gold. It's more volatile, more industrial, more explosive. Michael Oliver has a chart that tracks the momentum of the gold to silver ratio, and that momentum just broke down. That means the ratio is about to collapse. If gold remains at $3,000 and the ratio drops to 30, silver goes to $100. If gold goes to $5,000 and the ratio drops to 30, silver goes to $166. If gold goes to $8,000, which Oliver also forecasts, and the ratio drops to 20, silver goes to $400. This is not wild speculation. This is math. The ratio always collapses in precious metals bull markets, and the momentum reveals it's happening right now. Let me provide you a historical parallel. In 2007, lead was trading at 50 cents per pound. It had been range-bound for 30 years. Then China's industrial demand exploded. Lead broke out of its range. Within 18 months, it reached $1.75, a 3. 5 times move. Michael Oliver's momentum system caught that breakout. He informed his clients, this is the beginning of a multi-year bull market. They made fortunes. The same thing occurred with copper in the early 2000s. Copper spent 20 years between $60s and $1. 20. Then in 2003, it broke out. By 2011, it was at $450. Oliver's system flagged the breakout at $130. Early adopters made 3 times. The latecomers who purchased at $2 still doubled their money. The point is, momentum breakouts in commodities are explosive, and once they start, they don't stop until the supply situation is resolved. But with silver, the supply situation is not fixable. We have a structural deficit of 200 million ounces per year. There are no new megamines coming online. Existing mines are running out of high-grade ore. Recycling can't keep up. This is a crisis that will take a decade to resolve, and during that decade, the price has to ration demand. The only way to ration demand is to make the price so elevated that marginal users drop out. That price, according to Oliver's models, is somewhere north of $200. The structural deficit isn't theoretical. It's documented by the Silver Institute. In 2024, global silver demand exceeded supply by 184 million ounces. That gap is widening. Solar panels alone consume 150 million ounces per year, and solar installation is accelerating. EVs require silver. 5G requires silver. AI servers require silver. Every new technology is silver intensive, and the supply is declining. Primary silver mines produce only 25% of total supply. The rest comes as a byproduct of copper, lead, and zinc mining. When copper miners shut down unprofitable operations, silver supply drops too. And right now, base metal miners are struggling. Energy costs are up, labor costs are up, ore grades are down, the marginal mines are closing, and when they close, silver supply shrinks. Michael Oliver doesn't care about these fundamentals in his analysis. He's a pure technician. But the fundamentals confirm what his momentum indicators are showing. The market is tight, the buyers are desperate, and the price has to go higher. Here's where it gets fascinating. Oliver also tracks the mining stocks, and he's stating the miners are about to explode. Why? Because of operating leverage. A silver miner that produces silver at $20 per ounce cost. If silver is at $30, they make $10 per ounce. That's a 50% profit margin. But if silver goes to $100, they make $80 per ounce. That's an 8 times increase in profit margins. And the stock price typically moves 3 to 5 times the profit increase. So an 8 times profit increase could mean a 24 to 40 times stock price increase. This is why the junior miners are the highest risk, highest reward play in this market. But you have to be selective. Not all miners are equal. Some are hedged, some are in bad jurisdictions, some have terrible management. But the best ones, the unhedged miners in safe countries, are about to become lottery tickets. Oliver claims all structural momentum is pointing to the sky for gold, silver, and especially junior miners. That word especially is critical. He's informing you where the biggest gains will be. In previous commodity bull markets, the junior miners outperformed the metal by 10 to 20 times. If silver goes from $88 to $200, that's 2. 3 times. A good junior miner could go 30 times, from $1 to $30, or from $5 to $150. These are not theoretical numbers. This occurred in the uranium boom. Uranium went from $20 to $140, a 7 times move. The best junior uranium miners went 50 times. It occurred in the lithium boom. Lithium went from $6,000 per ton to $80,000, a 13 times move. The best lithium miners went 100 times. Michael Oliver is informing you the same setup exists in silver right now, and the clock is ticking. Let's discuss about the risk, because nothing goes up in a straight line. Michael Oliver admits there will be volatility. He stated, "Silver has seen sharp volatility recently, sliding about 16% from record highs before rebounding to those levels within just 10 sessions. That's a gut punch if you're not prepared. A 16% drop from $80 is a $13 drop, from $80 to $67. If you purchased at the top, you're down $13 per ounce. That's $13,000 on a 1,000 ounce position. Can you stomach that?" Most people can't. They panic sell at $67. Then the price rips back to 80 toes. They sold the bottom, they purchased high, sold low, they lost money in a bull market. This is why Oliver's message about pullbacks lasting only days is so important. If you know the dip will be purchased within 10 sessions, you don't panic. You hold, or better yet, you buy more. The weak hands get shaken out, the strong hands get richer. Michael Oliver is informing you to be a strong hand. He's informing you the structure has changed. The buyers are no longer traders. They're strategic accumulators. And strategic accumulators don't sell on 16% dips. They buy. So if you're going to play this, you need to accept the volatility. You need to have a time frame. If your time frame is Q2 2026, a pullback in February doesn't matter. If your time frame is, I need to make money this week, you're going to get slaughtered. Commodity bull markets are not for day traders. They're for people who can see the big picture and hold through the noise. Michael Oliver has been doing this for 40 years. He's witnessed every boom and bust. He's lived through 1980. He lived through 2011. He knows what a real bull market looks like, and he's informing you this is the real deal. Now, let's discuss about the counter argument. The skeptics claim silver has already tripled. It's too late. It's overbought. Michael Oliver addressed this directly. He stated why it's not too late for gold, $200 silver next year, and a massive surge for miners. That's the title of his December 16th interview. He knows people think they missed it, and he's explicitly informing them they didn't. Why? Because the momentum hasn't peaked. In a bull market, momentum peaks at the top. Right before the crash, momentum goes parabolic. We're not there yet. Momentum is strong, but it's not parabolic. There's still room to run. Oliver also points to the gold breakout. He stated, gold has broken out of a long-standing trading range, signaling the beginning of a potentially multi-year bull market. If gold is just starting a multi-year bull market, and silver always outperforms gold in precious metals bull markets, then silver is also just starting. The logic is airtight. The only way Oliver is incorrect is if gold crashes back below $2,500, but he doesn't see that occurring. He sees gold going to $8,000, and if gold goes to $8,000, silver goes to $200 minimum, probably much higher. Here's the setup for the next few months. According to Oliver, we're in the early stages of leg 2. Leg 2 is the acceleration phase. Price moves faster, corrections are shallower, volume increases, media coverage increases, and at some point the public wakes up. When the public wakes up, we enter leg 3. Leg 3 is the mania. That's when silver goes from $100 to $200 in a matter of weeks. That's when your Uber driver questions you about silver. That's when the mainstream media can't ignore it anymore. And that's when Michael Oliver will inform you it's time to take profits. But we're not there yet. We're in early leg 2. The professional money is buying. The institutions are positioning. The retail public is still asleep. You're not late. You're early. So what should you do? Michael Oliver isn't giving financial advice. He's giving technical analysis. But his analysis suggests a clear path. Number 1, if you don't own physical silver, start buying. Don't try to time the bottom. Dollar cost averaging. Purchase some now. Purchase more on dips. Build a position over the next 30 to 60 days. Number 2, if you're aggressive, look at the miners. Focus on unhedged producers in safe jurisdictions, Canada, USA, Australia. Avoid Mexico and Peru unless you understand the political risk. Junior miners have more upside, but also more risk. If you can't stomach a 50% pullback, stick to the majors. Number 3, set a time frame. If you're targeting Q2 2026, that's 4 to 6 months. Don't check the price every day. Don't panic on red days. Trust the momentum. And number 4, have an exit plan. Michael Oliver will inform you when the momentum peaks. He's been doing this for 40 years. He knows what a top looks like. When he claims the momentum is breaking down, that's your signal. Don't be greedy. Don't hold for $500. If he's stating the top is in at $220, take your profits, rotate into other assets, or rotate into gold, which is more stable. The goal is not to catch the exact top. The goal is to ride the trend and exit before the crash. Michael Oliver is your guide. Listen to him. We are living through a historic market event. Michael Oliver, the individual who called the 1987 crash, the person who has studied commodity cycles for 4 decades, is informing you that silver is about to explode. He's given you a timeline, Q2 2026. He's given you a target, $200 minimum, $500 possible. He's informed you it's not too late. The breakout is just beginning. The momentum has never been stronger. The structure of the market has transformed. Multi-month corrections are finished. Pullbacks now last only days. The buyers are strategic accumulators, industrial users, sovereign wealth funds. They don't sell on dips, they purchase. And that buying creates a floor that rises every month. The gold to silver ratio is collapsing, the miners are about to surge, the stock market is about to crash, and capital is going to flood into real assets. This is the setup of a lifetime. You have 2 choices. You can listen to the mainstream media, which will inform you silver is a bubble, or you can listen to Michael Oliver, who has been correct on every major commodity move for 40 years. The choice is yours, but the clock is ticking. Q2 2026 is 4 to 6 months away. If Oliver is correct, and his track record reveals he usually is, silver will be at $200 by June. That's a 2, 3 times from here. If he's really correct and it goes to $500, that's a 5, 7 times. This is not financial advice. This is technical analysis from one of the best in the business. Do your own research, make your own decisions, but don't claim you weren't warned. Michael Oliver just gave you the roadmap. The question is, are you going to follow it? Subscribe.